The market is crashing, stocks are tumbling, fear is everywhere. But here is the question. Is the market actually dangerous? Or is your brain making it feel worse than it is? Investing success is not just about picking great stocks. It's about how we think when those stocks are failing. Right now, the market is giving us opportunities, but most people, they will miss them. Why? Because they are too focused on short-term fear. In this video, we'll break down why the biggest danger in a market crash is not the market itself, it's how our brains react to it. So let's dive in! If you are new here, I'm a strategy consultant who has worked across North America, Australia, France, and the UK. I've earned a 21% annual return in the last 6 years by investing in individual stocks. That's 8 percentage points higher than the S&P 500 and nearly doubling my money every 3 years. I believe context creates value. If you are stranded in the middle of a desert and someone hands you a bottle of water, it's priceless. But if the same bottle is handed to you on a rainy day in Paris, you barely notice it. Right now, the stock market is that bottle of water. Think about this. If you believe Tesla was a great company in December 2024, you could have bought 21 shares for $10,000. Now, just a few months later, that same $10,000 gets you 42 shares. Same company, more value? So why does it feel worse? Because we have been trained to think of price drops as losses instead of as opportunities. Most people think volatility equals risk, but volatility is not loss, it's just movement. In 2009, during the great financial crisis, someone asked Charlie Munger if he was worried about the market crash. His response?
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in? No?
This is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get.
Think about that. If the greatest investors have sat through massive losses and still come out ahead, why do we expect the market to go up in a straight line? A stock price decline doesn't mean the business is worthless. It just means we have the chance to buy great companies at a better price. During a recession, the rules of investing get rewritten. The market is offering wonderful companies at a discount, but if fear stops us from acting, it doesn't matter. In 1974, during a brutal bear market, Buffett famously said, "I feel like an oversexed man in a harem. This is the time to start investing." He didn't wait for things to feel safe. He acted when everybody else was afraid. History shows us that the best time to invest is when it feels the worst. Fear in the stock market is not about numbers. It's about the gap between our expectations and reality. When I invest in stocks, I have no expectations in the short term. Why? Because in the short term, prices are driven by emotions. They can go up and down for reasons that have nothing to do with the actual business or my control. But in the long run, my conviction is different. If I buy a great company for less than it's worth, I strongly believe that the stock price could be higher in 5 to 10 years. Because as Warren Buffett puts it, if a business does well, the stock eventually follows. Stock prices fluctuate, but business value compounds. The mistakes most investors make: they anchor their emotions to short-term price movements instead of fundamentals. But when you let go of short-term expectations and focus on long-term business performance, volatility stops feeling like risk. It starts feeling like opportunity. Right now, the market is down, but business fundamentals are still strong. Stocks are cheaper, but most people are too afraid to buy. Volatility is rising, but this is normal. It's part of the game. Fear makes us believe that today's pain will last forever. But history proves markets recover, and those who stay invested are the ones who win. Everyone is asking, how bad will this crash get? But the real question is, will I have the discipline to take advantage of it? Because today's losers are tomorrow's winners. I don't know when the market will bottom, no one does. But here is what I do know. I'm looking for great businesses that have been unfairly beaten down. I'm putting more money to work, slowly, steadily, not all at once. I'm ignoring the fear because history tells us that this too shall pass. In investing, the best returns come to those who can see through the panic and act with rational optimism. Hope is not a strategy, but hope backed by history and facts, that's a plan. If this helped shift your perspective, hit like and subscribe. And let me know in the comments, are you buying stocks right now or are you waiting for things to feel safe again?